look at these numbers, it looks like there's, right, an advantage for the average C Corp, but it looks to me like the advantage is driven in large part by the fact that C Corps have lots of exempt shareholders, which are pension funds, foreigners, foundations, universities. Should we, from a policy perspective, should we care about that? And if you think about it that way, isn't it really more like pass-throughs have an advantage? Like, how should we think about parity in that context?
Yeah, well, I think aggregation is a big issue, and how OMB decides, or IRS and Treasury, how the regs come out, is a very substantive issue. It is the case that an S corporation could flip to a C corporation, if that was had no transaction costs associated with it. Not so easy to flip. So they might be kind of stuck in the current status. But they would then have to go out and acquire tax-exempt shareholders, right, in order to get the same tax treatment. So you would be having,
No, because their taxable shareholders would be treated just like a C Corp's taxable shareholders. Isn't it just because C Corps tend to operate in equity markets where they're attracting investment from tax-exempt shareholders? That's an artifact of the way they're organized, not necessarily like.
They call it an artifact of their investor base, right?
Yeah.
Their investor base looks like X. The S corps, they look like Y. They look like they're different for various reasons, and that gives you, that results in two different outcomes.
Yeah, if I could just add to that, so effectively, the C Corp cost of capital is less than if you're out there trying to raise money as an S Corp. So one of the reasons that S Corps have fully taxable shareholders is because of law. I mean, they're not allowed to have charities or other folks. So if I'm a C Corp and I'm able to go out and access sovereign funds and pension funds and all these folks who don't pay that second layer of tax, so their cost of capital is a lot lower. Their expected return is going to be a lot lower than somebody who's actually going to have to pay tax on that return. Then I'm going to be able to raise a lot more capital. I'm going to be able to raise it cheaper than the S Corp down the street. That's a really big long-term problem. And that's one of the reasons that S Corps were created in the first place, with the single layer of tax and what Doug talks about, the liability, the umbrella of liability protection, because closely held businesses, and this kind of gets back to one of the things that Doug was talking about, closely held businesses, the way to divide the business community is not big, small, all that stuff. It's closely held businesses who operate with one set of rules and one set of governance challenges, and public companies who are access to public markets and have access to all this cheap capital. That's the line of difference, and the difference extends beyond that. I mean, you've got the SEC regs and all the sorts of things that the public guys have to comply with, but there's an extraordinary difference in the way that a public company behaves versus a private company, and there's an extraordinary difference in the way a private company has to go about raising capital, dealing with shareholders, etc., versus a public company. There's an extraordinary difference in the cost or the sale of stock. I mean, if you're a private company, you really can't sell your stock. There's no market for it, or if you do find a market, you're pretty lucky. Whereas a public company, you're churning the stock all the time, so the cost of the stock is actually higher for public companies than it is for private companies. So that's, in my mind, I always really chafe at this idea of small versus large. It's not, it's closely held businesses versus public companies. That's the line that differentiates the two. And you really can't pretend that public companies and private companies can operate with exactly the same rules. They won't be able to. The public companies will over time take